Welcome, everyone, and thank you for tuning in to the Insight is Capital podcast. Today, I'm excited to have our longtime friend, Mark Noble, Executive Vice President, Head of ETF Strategy at Horizons ETFs, as my guest. Mark, how are you?
Great to be here as always, Pierre.
Amazing. It's been quite a year and quite a quarter all around. I thought today would be a good opportunity to discuss yield-producing assets, yield-producing investments. Mark, with market dynamics shifting in 22 and into 23, investors are seeking strategies to outpace inflation and traditional GICs, short-term instruments. So I thought today maybe you could shed some light on covered call ETFs as an alternative strategy offering. Also, I think you've called it portable yield. I guess we can call it monetizing volatility as well. So stay tuned. Mark is here. We're going to talk about all this stuff. We're going to talk about the benefits of covered calls, their tax advantages, and how they can enhance the yield of your overall portfolio without undermining your fixed income allocation. You don't want to miss this fascinating discussion on making the most of current market conditions.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Mark, welcome back. It's terrific to see you and catch up with you. As I said just a moment ago, what a year it's been and what a quarter it's been. Right? I mean,
really bizarre.
I think a lot of things that people, people have talked about this being, the at least the topic of recession, that this, being the most highly anticipated recession ever. But to me, like when there's that much consensus, there must be, possibly something wrong with that such a wide market call as to, I don't think there's any doubt in people's minds that there might be some kind of recession, but whether it's deep or mild or, whatever people are characterizing it as today, that's a whole other ballgame, right? I mean, in the meantime, things are really sort of up in the air. There's volatility. Markets are, bond markets all over the place. Equity markets have been all over the place or, very narrowly trading in a certain, very low breadth rally that we've seen in the S&P. So lots of uncertainty, lots of sort of not knowing what to do next is kind of a pervasive thought. And I think that's a perfect time to talk about what we are going to talk about today. But before we get to that, I just wanted to say, Mark, first of all, Mark, congratulations on Horizons ETFs launching Canada's first ultra short-term Canadian and US T-bill ETFs. How is that? I was surprised to find out as a result of your launch that before now there were no T-bill ETFs on the market. Why is that?
We were somewhat surprised as well. And while we were going through a launch, we were almost wondering, are we missing something here? Why is this opportunity available to us? But I think it's something as simple as the fact that if you were invested in T-bills, 18 months ago, you weren't getting much of a yield at all. And I think that the recurring theme in our discussion today is just going to be how fast interest rates have risen, which I think is creating a lot of this uncertainty you're talking about, because a lot of us as investors and even professional investors have a strong cognitive bias to the last 2 decades of low interest rates that we're just not there from a headspace to understand what has occurred in terms of the speed and rapid growth of inflation and interest rates and what that means for the broader investment portfolio. We're in a completely new regime. And so in the case of treasuries, there was just no real reason to own them other than as a ultimate risk-off asset as a placeholder in case you're in sort of a apocalyptic market condition. So, March of 2020s and the financial crisis where the only safe place to be was basically in cash or in treasury.
Yeah.
So, I mean, there's always been a portfolio aspect. But what we see now is, your rate on 3 months T-bills is roughly 5% on the US T-bill. And that's fairly attractive from a historical perspective. But that's only a recent 3 to 4 month phenomenon in terms of getting that high. And so I think that we were just recognizing that we're seeing an incredible influx into cash products in Canada, which have really been the proxy for the treasury trade. And so we looked at that environment and said, there's probably a place now for T-bills alongside the cash alternatives, because Canadian investors clearly have a huge appetite for cash. And it's actually astounding, Pierre. It's last year, we raised $8 billion in the Canadian ETF market in cash products. We're closing in on $20 billion in cash alternatives. And this is a category that was pretty much close to nothing 3 years ago. So this is a real asset class that is offering compelling returns for investors that never existed, because we're looking at 50, 25 basis points kind of returns in previous regime. But now investors, with their concern about everything else, their cognitive view, their cognitive anchor is towards the idea, okay, I can get 5% from effectively risk-free assets, which is why I'm looking at these products.
Yeah, I mean, I also view it as a sign of the times. It's just, I mean, we're at this pivotal moment, right? Where you're absolutely right. A year ago, these yields didn't exist, right? I mean, a year ago, nobody was asking for money market funds. Nobody actually thought, the market's going to go down. I need a safe place to run to, and if I do that, what's the opportunity cost of doing that too, right? I mean, all of those factors. And how long ago? I'm curious. How long ago did you start working on this launch?
We have a product development team that's been always looking at things. So this has been a product that's been at the forefront for a while. So the ETF is called
I'm saying that because you didn't just decide, since the banking blow up in the U.S. to create a product that people could sweep cash into, right?
No, there's been well-established trend in the U.S. with the ETFs that cover that here. So our ETF up here is C-bill, CBIL, right? Which is the Canadian version, and then we have U-bill, UBIL.U for the U.S. version. And these ETFs there is a little bit of a market timing to the launch, just in the fact that we've been so extraordinarily successful at raising money into our high interest savings ETFs products. So we've raised over $4 billion with our firm alone last year in that particular category.
Right.
But you were saying that the interest rate curve, it seems to be the overriding theme in everything these days. The banks are actually, if you look at GIC rates, for example, they're actually bringing those rates in. So you're high on the 1 year, of course, because the short end of the curve is high. But actually, if you look right now, a 5-year GIC gives you less interest rate than a 1 year cashable GIC. I've never seen this in my entire career. And so if we're looking at tactically, where does something like this fit as a cash alternative? Well, okay, it may actually be that on the high interest savings products, at a certain point, there might be a backup on rate, because those rates are actually being delivered from the bank depositors, extraordinarily safe ETFs with a very attractive yield being paid by the deposit-taking institutions, which are the large Canadian bank. But there could be a diversion, and we're already seeing on the GIC space, where the interest rates that they're giving you are different than what the government's going to provide on the overnight. And that's just this actuarial view that the interest rates are going to come in. So we actually think that there could be some positioning at a certain point in time where the yield that you're getting on short-term T-bills is just as attractive or in the same vicinity as what you're getting on high-interest savings accounts. And of course, there's other aspects to holding something like C-bill, which is where you're really not worried at all about credit or deposit risk. And you really shouldn't be worried about it with the cash ETFs either, but it is something to keep into consideration. And then you've got also the fact that that short end of the curve is the most attractive yielding end of the curve for all investors. So I was, just seeing that yesterday, for example, that the 1 month and 3 month difference in yield is the highest inversion that's ever occurred. And the 3 months to the 5 year is the biggest inversion that's ever occurred. So actually, just from a yield generation perspective, that extreme short end of the curve is the most attractive end of the curve. So if you're an income investor, it makes sense to be there. So you've got these two really attractive drivers for this asset class. Number one, you've got it as a potentially very attractive cash alternative, but you also have it as a very low risk way to generate income on the bond portfolio. And so treasuries, no surprise, have been an incredible driver of assets in North America. And that cash alternative space in the U.S., for example, has seen over $32 billion in growth over last year. So we've obviously been watching this trend and waiting for that sort of be recognized by the Canadian marketplace.
Amazing. It's such a, I mean, as you said, it's such a strange time, but we're sort of, we were in this, bear steepening for most of the year. Now it's starting to look like some bull steepening in the yield curve. And you're going to want a barbell, right? This makes it really easy to create a barbell in a portfolio. It's right there. It's very handy. I mean, it's very straightforward too. So I don't want to spend the entire conversation talking about something that's actually pretty plain vanilla. It just makes it really easy to buy T-bills now without actually having to go and buy them directly, which is what traditionally people did in the past, right? Or you buy a money market fund, like a mutual fund.
You have to manage those maturities yourself.
Yeah. So is it safe to say that we're in likely a higher for longer, meaning there might not be a significant amount of rate hike, activity in the future, or none at all. But that doesn't mean that doesn't imply that there's going to be rate cutting either. So given that we're going to be in a period where rates are where they are today and at the terminal rate that was, forecasted by the Fed, by the Bank of Canada, that transition that we're starting to see, we're starting to see the knock-on effects of rates coming into the market. We're starting to see, some things break. We're starting to see pressure on real estate. At least there was pressure on homes until Tiff Macklem sort of backed off on it in Canada, yesterday's economic report. But there's a lot of uncertainty because of what's yet to happen as a result of the absorption of higher rates. So that makes for a lot of uncertainty, a lot of volatility. Here and there, we'll probably see some spikes. But that elevated volatility and in some cases, there are some areas of the market that are very interesting, very attractive places to be. And using covered call ETF strategies, really, you can participate and get paid while you wait as well, get a yield. I think one of the, I listened to your podcast with Nick Picard about covered call gold ETFs. Right? I mean, like with bullion, if you just bought gold or GLD or something, or a gold bullion ETF, you're waiting for something to happen to gold. I mean, it has happened. We've seen a nice increase in the value of gold with the dollar coming off and buying in gold rising. But while you're waiting for those activities to occur in the market, that behavior, that pricing to happen, you're not getting paid. But with a covered call ETF that buys bullion or buys gold stocks, you are, right? I mean, I'm just bringing that up as an example that's an area where people might have some interest or an outlook that's alternative to what they're doing in their traditional portfolio. But maybe, let's, I don't know, maybe we should start at something like the beginning.
Okay. How far back we going? 1937?
Yeah. Well, I think what's interesting, I remember talking to you and your colleagues back in 2009, 2010 about covered call ETFs, and the difficulty then, because it was a fairly new idea in Canada.
Right.
Buy right strategies have been around for a long time, but it was a new idea. I remember, and of course at the time maybe there wasn't the kind of demand there is for it, potential demand for it now, but it's become pretty mainstream now, right? I mean,
very, very mainstream. Yeah. You're looking at $1 out of every $4 in the equity market last year in the Canadian ETF space went into covered calls. And initially, just like the cash trade, you're kind of worried that it's like this self-directed, driven, because there's a lot of self-directed investors in here. I would estimate about 50% of that flow is self-directed.
Yeah.
But you're worried that they're just chasing yield. But when you dive deeper into the hood, that's not actually the case. And it's the same with the cash trade, because cash was probably second or third best performing asset class last year. And covered calls dramatically outperformed the equity market last year. And the reason is because of how high the volatility and premiums are in covered calls. So as someone who likes to talk about full cycle investing, I'm not actually a huge fan of covered call ETFs or covered call strategies historically.
Yeah.
Okay. And that's just because my career has been demarcated by incredible bull market for most of my career. I started during the financial crisis, so I've really ever known, the bottom and up. And
I suspect that experience is the same for a lot of advisors as well.
Yeah,
which is
for the most part.
The question was always why, right? But now what's changed is that the impetus has changed, right?
Correct.
Now,
yes, thank you.
Right.
Yeah.
So,
and go ahead.
Go ahead. Then you go ahead.
And so what that means is that you're now being compensated for covered calls in a way from a risk return perspective that you weren't when volatility was low. And so if interest rates are the primary driver of fixed income, volatility is the primary driver of growth in income for covered calls. So just to give you some, historical context, if I was to write a 1 month at the money call option, so 1 month at the money call option means I'm going to give away all my upside, but you get all the premium on a NASDAQ 100 index option. Right, and the NASDAQ is interesting because it's a slightly more volatile index and it's got a lot of the large U.S. names. That will currently give me about 2.5% a month in income, a month. So I'd be looking at nearly 30% annualized income just from doing that.
Right.
That's what the market is giving you. And the reason being is that in previous podcasts we've done, I've talked about the incredible number of new investors that have come into the marketplace in North America. And one of the things that they are doing is they're in a very large way buying call options. This cohort of retail investors likes to go long options. And we've even seen some, I would say, troubling developments, such as the development of 0-day expiry options, which is like options that you can just buy the day and they expire that day.
Right.
And they're proven to be quite popular. That created an incredible amount of demand for call options. So everyone on the other side of that trade is getting higher premiums in general. I would say that your average run rate on premiums has just gone up because of this demographic shift.
Right.
And then you've got the second part being is that as interest rates have risen, it's created more volatility in the marketplace, which happens with earnings and other types of market conditions. Interest rates, as they rise, it's a disruptor. It starts taking things. It creates volatility. And that's also created these high levels of premium. So with covered calls, your goal is to sort of generate, if an ideal covered call strategy, you're sort of trying to generate 70 to 80% of the capital upside appreciation, and then then a high level of monthly income. Like you're trying to create immediate income in exchange for selling some of your future return. But that total return ideally is sort of in line with what you would get with just going long the underlying equities. And what we're seeing right now is, in some cases, you're actually doing better with a covered call strategy, or you're very close to that total return. And because Canadian investors in particular have such a high demand for income, they're using, as you highlighted, what we call portable yield, is they're saying, look, I don't know when the market conditions are going to stabilize. Let's take the NASDAQ 100, for example. So the NASDAQ 100 is probably going to give me a fair amount of equity growth over the next 2 to 3 years because it's a large mega cap U.S. name. It's had a big sell-off already, but I don't know when it stabilizes.
Right.
I'm going to go long into that, but through a covered call strategy that's going to pay me 14% annualized yield right now because of how high premiums are. And I'm going to get right now somewhere in the vicinity of 80 to 90% of the upside return because of how high those premiums are. And so for an income investor, they're getting paid to wait. And so our ETF, like QQCC, for example, we started the year at like $12 million in AUM, and we're over $100 million in less than 3 months because of this very tactical, but also what I'm trying to highlight now, a very rational approach to investing where I can generate from these high generational volatility levels a level of premium and income that hasn't existed before.
Right.
And it makes sense from a total return perspective.
Yeah, not to mention that it's probably also a really good time to make a lateral move like that and trigger some
Correct.
tax loss harvesting.
Yeah.
Right.
We saw a lot of that at the end of the last year.
Yeah. But then you could still carry that on into this year, even though NASDAQ's up 20% this year. There's still lots of downside capture on the tax loss harvesting available. I don't know. Maybe the motivation's not as great as it was as at the end of last year to make a lateral move, but the opportunity is still there, obviously, to capture some of those tax losses and make a move to an income generating version of the NASDAQ index, right? So
exactly, or any other kind of equity index. Yeah,
you could do that. You could do that across the broader indices. You could do that across some of the interesting alternative assets that are available, like gold, for example, getting paid to wait while you own gold. And I think it's fantastic. Now, maybe I don't know if we want to start from square one, but in terms of monetizing volatility, I think you've covered that, right? We've talked about how that happens, and I think pretty much advisors are familiar with how options work, obviously, but obviously in a heightened period of volatility, in a period of elevated volatility, you're going to get much higher option premium when you sell, when you write the calls, right? When you sell the options.
Yeah.
Now, I don't think anybody actually, I don't think, the majority of advisors want to actually do it themselves, but that's why these strategies exist, right? It's far more efficient. How is what's the tax treatment on, so we've talked about making a strategic move for income, making possibly even a strategic move for tax, from a tax loss harvesting point of view, if you're going to maintain an allocation to the same assets that you already own, that maybe you went through last year with losses, and there's also a some tax preference treatment.
There is
tax preferential treatment on covered call income as well, too, right?
There is. So covered call income in Canada is viewed as hedging, so it's actually treated as capital gain.
Right.
There's a few nuances to this. One, most of the premium return that you generate from writing call options will be taxed as capital gain if it's net accretive to the total return. That is, it's more than what the capital appreciation is. Where covered call ETFs are tricky and this is for advisors and investors, where they're tricky to kind of get your head around is that at the end of the day, you really should be looking at the total return, right? Like if you're going to generate 20% annualized returns from the capital appreciation side of the NASDAQ 100, that's going to be taxed to you as capital, right? If you want to sell that. And so why would you give that up to earn 12% writing covered calls, right? That's something that people need to get their head around. But in both cases, the returns of these strategies are going to be capital gains because the premium income is taxed as capital gain. The exception is that if these ETFs run into a scenario where the capital appreciation, that is the capital appreciation of the underlying securities, is negative, but because these ETFs pay out income on a monthly basis, if they pay out more income than that capital appreciation, there's a shortfall. And that shortfall would mean that it's taxed as return on capital.
Better.
And so that
works out that way.
Well, it is better. It's better, but from a mathematical perspective, at the end of the year, for tax reporting purposes, you're in a loss scenario and you've paid out income, so it's return of capital.
Right.
And some people think, is that grinding the NAV? Well, no. All the premium that's being paid by these, and that's not just our ETFs, most of the ETFs out there, all the premium that's being paid is being paid net of the net asset value, generally speaking, but you can run into a scenario where, from a mathematical perspective, the net asset value, particularly at the end of the tax year, has been grinded to a certain degree because of that mismatch between income and what's being paid out and what that NAV or net asset value is. So that's where you end up with ROC. And then some of these ETFs also pay out dividends, so that'd be Canadian eligible dividends, but for the most part, extraordinarily tax efficient. again, which just drives a lot more interest from retail investors who realize that they're getting that a benefit, extra tax benefit of generating this income versus what they would get with interest income from bonds or other products where it's taxed at a higher marginal rate.
Mark, do you have any favorites? Do you have any that you think are particularly timely right now?
Yeah.
And I think it's interesting. Like before, is sort of in background in preparing for our conversation. I was thinking in a way I haven't thought before, which was that these are alternative assets, right? And they're interesting, diversifying strategies. Really, if you think about it, like if you
I don't know if I would agree with that actually.
Okay.
I would agree. I would agree they're an alternative asset if you're writing all the upside. So if you're writing a strategy that's like 100% written on, and you're writing it at the money or close to the money,
okay,
then you completely change the return profile of that underlying, and I would say that's more of an alternative strategy.
I don't want to give it I don't want to give it a CIFSC classification. It's just something I'm using the term very loosely. So
but your risk return profile on a NASDAQ 100 covered call ETF is the NASDAQ 100, right? Especially on our products where we're never writing more than 50% of the portfolio, and so on a Canadian equity product, it's Canadian equity, and that's really important because I actually get a lot of investors who will ask us, like, why did I have losses on this portfolio if I generated double-digit income, but I'm negative on the year? Well, it's like, well, yeah, you were invested in gold equities last year, which declined like 14% or whatever it was. So you didn't generate enough income to offset the losses in that portfolio. So
that also assumes not reinvesting.
Yeah, it assumes it's not reinvesting, but still from a total return perspective, you're still negative. So they're not. I'm just saying, in my personal opinion, the majority of covered call ETFs, if they're writing on only less than 50% of the portfolio or less, I would say that they're not alternatives. They're just an equity alternative or an asset class alternative. Now, I would say that a covered call ETF that writes 100% of the money or at the money, I would say that's an alternative asset class because you've meaningfully changed the drivers of risk and return or where that fit. So, it's something that's important to highlight because a lot of people don't understand that the equity risk is what drives most of your risk return profile on these strategies. But in terms of why we're at where I'm in favor of, I do think the gold story is very, very interesting. And I make a joke in presentations. I said the only thing historically I've liked less than covered calls over the last decade is gold. But I have you have to be open-minded to regime changes, and again, going over my own cognitive bias of what the history says, and look at what's happening in the gold market. And what's happening in the gold market is astounding to me. First and foremost, it's the central bank gold buying. Central bank gold buying is the highest level it's been since we moved off the gold standard. So and it's funny because I was looking at a chart where it's showing like the most amount of gold buying was like 1970, 1971. Well, that's right where we were moving off the gold standard. And why is that? Well, it's because there's an incredible unfunded liability from the major emerging market economies by the sheer number of US dollars that they hold. So if we reach an inflection point on interest rates, and that's now going to be devalued, they need a store of value to protect themselves to this incredible devaluation of the US dollar that could occur. As well as I think also, I think we can be pretty honest in that there's also macroeconomic and security concerns about the prevalence of the US dollar. That is an incredible driver for gold. And gold equities in particular really haven't meaningfully participated in that upside that we've seen in gold. And there's usually sort of a 3 to 6 month lag. And so the price to earnings ratios on gold stocks, all I'm saying is the valuation of gold stocks seem a little high, but they're nowhere near as high as where gold's actually trading. And they get all that leverage on what occurs. So the covered call strategy on gold makes a lot of sense to me because it's a slightly volatile equity category, but your premiums there are very attractive on gold. And there does seem to be a very large macroeconomic shift where gold is becoming much more in prevalence from a macroeconomic perspective because of those macroeconomic concerns about the US dollar, as well as those larger security concerns about the U.S. dollar. And so this is an asset class that's very much in play, and it's not being really meaningfully valued yet, I think, relative to those larger items. Now, a gold bug would come out and tell you about M1, M2 money supply, but I feel like that's a bit of a broken record because they tell me it doesn't matter what time of the day or year it is, they're going to tell you about M1, M2 money supply and devaluation of U.S. currency. But these are new factors that I think have forced us to reevaluate the value of gold.
Well, I think like most things in the market and most trends and especially the change in regime that we're seeing, it happens very slowly, like Hemingway, it happens very slowly and then all of a sudden, right?
Yeah, you get hit in the face.
But it hasn't yet, right? I mean, like people expected, I think in the face of inflation last year, people definitely expected, gold's going to come through. And, especially the gold bugs thought that, but it's happening more slowly. And then if there is a critical mass at some point that tips the scale, an event, some exogenous thing happening, then maybe you get that tipping point where gold, takes off to a whole new level.
Well, and it's a deflationary asset. So it will, if we hit a recessionary conditions, gold should do well because it's a store of value. And then the value of all dollar denominated assets that comes in, gold holds up. So
sure.
And then held true through history.
Yeah. And we only saw recently the dollar come off its peak. So
correct.
Remains to be seen where it goes from here. And obviously if rates start to, regress back to lower levels or the terminal rate eventually gets cut, that will change the dynamics for the US dollar further, right? I mean,
right. Yeah. The only exception to sort of that narrative is I do think the SVB collapse was a watershed moment. And again, my formative years in this business are the financial crisis where I was a journalist covering that. So I got really deep into that particular segment of the market, especially being a frontline kind of reporter on that. And the echoes of that were fairly similar to me. So SVP collapse, what that effectively did, in my opinion, and I could be wrong, right? And I'm wrong a lot of times. So let's have that caveat there. But effectively, in my opinion, the Fed's willingness to backstop all of those treasuries, the held to maturity treasuries, and create that discount window for the bank to access was effectively a form of quantitative easing. We call it whatever we want, but it's created an incredible expansion in a very short period of time of the Fed's balance sheet.
Right.
So they're in a weird situation right now where they have interest rates high and they're basically taking all of these treasuries onto their balance sheet from the banks when there's hundreds of billions of dollars of these. And it's kind of hard not to see that they have to be, if they're not going to cut, there has to be done, right? Otherwise, they're just inflating away their own liability on their balance sheet. So there was a rescue and a bailout in place to stop financial crisis contagion. And it's primarily because it wasn't just those small regional banks. They were just the most impaired from a deposit-taking perspective. It wasn't just those small regional banks. It was the small regional banks that had these holdings. They were just impaired because of the run on their deposits, right? So their balance sheet mix-up. But there's hundreds of billions of held-to-maturity treasuries in loss position across all the major banks.
Exactly.
So that's huge. Yeah. And that's an incredible amount of contagion that the Fed has to reconcile with. And it is very similar to the financial crisis. We had a similar situation where it wasn't treasuries, it was mortgage-backed securities and credit default swaps. But this stuff can really expand very quickly and it can completely dry up all the liquidity in the system.
Yeah.
So the Fed did step in to fix that. And that shows kind of a moment where we probably had very close to a breaking point in the marketplace. I do believe that. Now, has it been solved? That remains to be seen. But, the ability to continue to increase interest rates now becomes very much a buyer beware kind of scenario where you're just going to continue to stress test what's clearly a fragile financial system. And if that financial system falls out, then we end up with that 2-3 standard deviation event where everything does break. So that,
and a lot of people, it's true. I mean, a lot of people who are circling the Fed, former Fed officials, are all like saying, hey, stop. right? Stop
Yeah.
and wait. Like, just watch. Like, I know Claudia Somm, she's a stay-at-home macro former Fed official. She's basically saying, like, just pause and wait and watch. Just watch wait a bit. What is this gung-ho thing that you have to channel Paul Volcker and keep at it?
Right.
It's crazy that I think the interesting thing about the Fed window, like, there was all these questions at the time, right? But why didn't they go to the Fed window sooner? Why didn't they go, and number one, I think, was that they couldn't, because they were held to maturity assets, right? So,
Right.
Number two, who else has held to maturity assets like that? There was 190 billion or 165 billion dollar drawdown at the Fed window that week, the
Right.
week of the closure. But that was very public, right? A lot of the regional banks don't want to go to the Fed window because, just like, they made all the big banks take the money at the bailout so that nobody would get the blame, like the firing
Right.
squad. The firing squad trick, the control shooter. Nobody gets singled out, right? So the regional banks don't want to get singled out, and so then the more quiet window for liquidity is the Federal Home Loan Bank, FHLB facility, which drew down over $300 billion the following weeks, right? But it's not the Fed window, so
No.
it's not publicly visible. It's a swapping loan facility, right? And restoral. The other funny thing that happened, right, was that the big banks that received the deposits, basically said, we don't want it, and gave it back to lent it back to the regionals.
Right.
Right.
And the bond market and the bond market the whole time is pricing this in as a backstop, right? So rates basically hit a high at this period, and the curve starts to be more inverted because, again, right or wrong, this could end up being like the worst consensus trade ever, right? It really could. We could end up being completely wrong on the aggregate wisdom of the market could be completely wrong on the curve, and that the curve may blow out and go back to normalization. But what they're betting on is that it isn't, that you're going to see these short-term rates come down and go where the curve is going, because they view that the Fed is not going to want to be just continuously increasing the unfunded liability on this balance sheet, right? And so that's how the bond market has reacted. Now, this is policy versus investing. There could be a situation where interest rates stay high at that level, and everyone who's betting on this pivot gets absolutely destroyed. And again, mathematically and from a risk perspective, it goes back to our start of our conversation, but it means that really the only safe part of the curve, if you're not being tactical or you're not trying to have a conviction play, is really to be short, because
the front end,
you're protected. Yeah. And then that's just because you've got the Fed saying one thing and you've got the market saying something else. If either one of them is wrong, then you're going to end up in a situation where things unravel very, very quickly.
Well, what if the reality is that the Fed has overshot? I mean, the likelihood that the Fed has overdone, over tightened, is one possibility, and the other likelihood is that the bond market has overshot its pessimism.
Right.
So somewhere in the middle is that sweet spot, right? And that's kind of the somewhere in the middle for covered call strategies as well, I think, given that we're in this period of volatility.
Right.
It's not a 30 handle or it's not that kind of level of volatility, but it's definitely sort of, the temperature's turned up. It's like a light, like a fever.
Right. Well, as I mentioned, it's a third way to generate income, because if you've got interest rate volatility and you've got uncertainty around inflation, then that's actually creating volatility. That volatility is a driver of income for covered calls. And again, historically, you can look at a chart to see implied premium. They're higher for covered call strategies simply because of this back and forth and this volatility that exists. So you're being given, I don't want to call it a gift, but you're definitely being given an advantage right now to be a call writer, because you're getting compensated for these strategies. So you're absolutely right, Pierre. very, very attractive market conditions for call ready.
All right. I think we covered that topic pretty well, but
yeah,
I love the fact, covered calls. It's funny, you have this strategy, you've had it for so long. It's always there. It's always, it's been there forever, like available, but really the conditions were not optimal for it as they are now.
Correct.
And that's the key to our conversation.
Yeah.
Mark, thank you so much for your incredibly valuable time. I love talking to you. We love having you, and
I like being here.
So yeah, it's been a great conversation. Thank you so much.
Yeah, my pleasure as always, Pierre.
Great to see you again too.
Thank you.